Welcome to Sathishspeaks channel. If you are having apps, business news apps like Money Control, Economic Times, you will be flooded with notification, and especially the notifications around recession, GDP slowdown, stock market crash, correction. There will be many negative sentiment news are actually coming out from these apps, and there are so many investors asking me queries, comments, questions about what is recession, or are we already in recession? Is recession going to come? And most importantly, as an investor, what should I do if we are going to get a grip of recession? So what you have to do with your portfolio, it can be either mutual fund or that can be equity also. So everything you will get it in this video. I am Satish, financial consultant and author of this book called Untold Wealth Secrets. Author of my second book, which is Middle Class to Million Dollar. Both the books are available in Amazon and Flipkart. And also I write a personal finance column in Nanayam Yugan, which is Middle Class to Millionaire. If you need any recommendation, advisory in mutual funds, stocks, equity market, my WhatsApp number there in the description. Connect with me, happy to assist you. And if you want to join my free Telegram group, again there is a link there in the description. So connect with me. I'll be offering free personal development kind of updates on the particular Telegram channel. And if you are watching this video, please be generous, please click the like button. So let's understand what is recession first. Recession means it is a general slowdown of GDP. That's all in simple words. So if the GDP contracts, shrinks or fall consecutively quarter after quarter, then it is recession. And many investors get confused between recession and depression. The biggest difference is recession is a normal slowdown, it is a business cycle, but depression is a sudden fall in the GDP. For example, in 1930, in last 100 years, there were only one occasion and the depression has come, that too in 1930 in America. At the time, the GDP was fallen by 50 percentage. But recession means there will be a general slowdown in GDP. For example, in simple words, if you are in a job and you are earning 1 lakh rupees, your salary is cut by 5,000 or 10,000, then it is called recession. Still, it is manageable. Yes, something bad has happened, but it is not that bad. But depression is even they take away the entire job, then it is depression. That bad is depression. The good news is we are not in depression, we are only in recession, and the average time frame of recession is 6 months to 2 years. The worst recession also will always get recovered in 2 years time frame. The average period of recession is always 10 months. It's only 10 months. So that's the good news. Recession is nothing but a normal business cycle in any economy. See, in economy, there will be 4 phases. There will be always an expansion phase. When the expansion phase goes up, when there is a peak productivity hits let it be the company or let it be the GDP, there will be some kind of a contraction happens in the peak. So the first phase is expansion. The second phase is the peak. The third phase is a slight contraction happens. Normally, whenever the peak hits, there will be a small fall happen, the contracts happen, that is called recession, and that period will be very less periods. Typically last between 6 months to 2 years, and then there will be a point called trough. From that particular point, again the expansion starts, and it is perfectly normal. We always slip into recession, and again the expansion start, and it is a cycle. So whenever there is any excess liquidity in the market, the liquidity gets sucked up. That is what the general phenomena about recession. So during the COVID times, we have a huge amount of liquidity. Money gets printed both in US, back in India, everywhere, and then it went to the bank, and the bank started offering loans to both individuals as well as to corporate at a very, very cheaper rates. So whatever happens in excess, the value of it will go down. That is the normal phenomena. Whatever is there in excess, the value will go down. So the money value goes down, and then the inflation goes up. So this is the first stage in recession. So now the inflation is already up, and the federal bank as well as the RBI both increased the interest rates. So that's the first step. And now the excess liquidity is getting sucked out of the market. The money is going back to the federal houses or the reserve bank. Now what happens? Whenever interest rates goes up, the corporates stop taking the loans from the bank because they have to access the loan with a higher interest. If they access with the higher interest, there will be a hit in the profitability. So they halt all the expansion plans, isn't it? So whenever the loan rate goes up, they halt all the expansion plan, and then they cut their outlook, they cut their forecast. So that means that they are preparing already, they preparing themselves, and they are preparing the market also with the outlook saying that, hey, I'm not going to post that kind of a numbers what I posted last year, so there might be a small reduction. So that is the second phase of the recession. The third phase is the IT companies, always the first company to take a hit. That means that if any corporate house have to cut down the expenses, they will cut down the expenses in advertisement, marketing, and in IT, because nothing is majorly gonna disrupt the company performance or the day-to-day activity if these three activities get stalled, or let's say that they slow down on marketing, advertising, and with the IT. So that is why the IT stock got hit very, very badly, both in US as well as in India. So these are the some symptoms of recession. We are already in a recession, but we don't have to worry, because recession, we have seen historically, we have seen that it gets recovered in 6 months to 2 years. If you are having a portfolio which is a long portfolio, that means the portfolio which is 3 to 5 years and 5 years and above, you don't have to bother. Please do not change asset allocation. Please do not do any changes in your portfolio, but rather the uncertainties, the recession are the best times to add quality stocks to your portfolio, mutual funds or stock, both. Only thing you need to ensure it is, it should be a high quality, well constructed, good high focused stocks. Buy and add it up in your portfolio, so that when the recession slips out, the trough period come again, the expansion start. The first thing is that the stock market will never expect the GDP to post good returns. The stock market will automatically goes up when they see the expansion phase. So as an investor, what you can do, build emergency funds, keep some adequate cash, because most of us will cut down the luxury spending, entertainment spending. They will keep that money with us for emergency kind of a situation. That's normal, that's okay, but you don't have to do anything change or anything dramatically with the portfolio. Do not do, and never ever advise that. Volatility are always a good time to accumulate more stocks if you have time in your hand. Equity investment is always about 5 years and above, and I repeat, it is 5 years and above. If you have the 5 years of time horizon, do not bother. This is just a temporary phase. Okay, if you need any recommendation, advisory on stocks, mutual funds, direct and equity, my WhatsApp number there in the description. Connect with me. If you are watching this video, if you like the content, please click the like button, because the chances of this video reaching multiple people high when you click the like button. And most importantly, stay tuned to this channel. I will be bringing much more informative content on mutual fund, equity, and personal finance. Okay, stay tuned. I'll see you with another interesting video. Bye bye.